Thanks for tuning in to Talking Point. I'm your host, Niraj Shah. Joining me today on the show is Vinod Karki, Senior VP Equity Research at ICICI Securities. Vinod, always great having you. Thanks so much for taking the time out and being with us. Vinod, before I get to the crux of what you've written on the note, it's a question that's been coming to my mind every single time people talk about dips in the markets. I would love to understand how you think about it, that whether this particular cycle since post-COVID is materially different than what's always happened in the past, in that there was a large dominance of global flows, which when turned, moved out, were not sticky, and therefore brought the markets down quite a lot. In this case, FI ownership in Indian markets are probably at the lowest that they have been in some time. And the domestic flows of 9,000-10,000 crores of net flows into SIPs make it a very sticky flow that comes into the markets every single time. So is this time really different?
Hi, Niraj. So I think I see markets. If you see historically, they have they're never quite different. I mean, it's more or less the same story, but in a different package. So the clearest comparison can be made from an economic perspective, where the demand is panning out in the economy. We had a similar patch between 2003 and 8, where you name the companies, they were similar in the sense, the capital goods, real estate, utilities, infra. Uh, Banks so far haven't been participating, which makes them value in this cycle. But eventually, there is no investment cycle, so as to say, if banks don't fund this investment cycle. So the point is, while the market has already, kind of made up its mind that there's an investment boom coming, that's why all these sectors are rising. But somehow the assumption is that there will be no releveraging cycle, which from a macro perspective cannot happen. You cannot have an full blown investment cycle without the releveraging cycle. So that's the thing. In terms of from an economic perspective, we have seen a similar story play out between 2003-8, where the balance sheet driven companies were really outperforming. Now, coming to the flows perspective, see what happens is, post COVID, you saw interest rates go to zero and negative in certain countries, which really flared up the valuations. Since then, we have seen a mega interest rate up cycle in the US, which I think is the key driver for these outflows and the fluctuation in the outflows. I think that cycle is more or less ending. So from that perspective, given that India macro story remains intact, and this pressure which was coming up on equity valuations because interest rates were rising very swiftly, that will ease. But having said that, the domestic flows have been so strong that it did not give an opportunity for the market to become cheaper, significantly cheaper, even while this volatility in FPI flows was seen. So that's why I think you might get into some kind of situation where the market has run ahead of what the fundamentals suggest. So the market cap to GDP is almost approaching 150%.
Vinod, sorry, which I agree. But the point being, these arguments about steep valuations have been there since 21,500 levels, right? We are circa 25,000 currently. That's precisely my question. Are flows really driving the markets higher, or making sure that the markets don't see a significant dip? I was looking at your note, for example, right? And while we talk about how mid caps and small caps are filled with froth, and yes, a lot of those pockets are, but when I look at your own data, if you look at MFs and FPIs, which are the largest contributors, presumably, of flows, while MFs have put in money into mid caps and small caps, where FPIs have pulled out the money, is largely from large caps. Mid caps and small caps haven't seen that. So therefore, are flows determining the market mood higher?
Yes, yes. So that's what I was saying, that there is, despite this huge volatility in interest rates and I mean, we saw volatility in outflows from FPIs, but on balance, the market has not corrected to the extent it should have, given such fluctuations in interest rates as well as FPI flows in between we have seen. That's because whatever selling came from FPIs was more than soaked up by the domestic investors. And now FPIs, because they don't see much issue, they have started jumping in. And what is happening with FPIs is a classic case of trying to undo some of their portfolio orientation, which is resulting in underperformance. So you have to remember that FPIs traditionally have been buyers of what you should say, the high quality companies in India, which we have seen that are underperforming. So if you look at their sectoral flows, also YTD, one thing is remarkable, that the largest outflow is coming only out of two banks, private sector banks, which we know are high quality assets basically. And they have, within banks, they have actually bought into the lesser quality PSU banks, have seen inflows during this year, and some other private banks which are not that high quality also, So, and what are the next sectors which have sold? They have sold consumer staples, IT, and energy. And what have they bought during for the first half of this year? They have been buying all the high beta stocks, basically. So, be it real estate, PSU banks, and capital intensive sectors like telecom, utilities, those kind of things. So, it doesn't give me a sense that FPIs are negative overall from a domestic economy perspective. They are buying smaller size companies, selling the darlings which they used to have, the large cap quality companies which they have been accumulating over several years, and so they're more kind of recalibrating their portfolios towards riskier assets because they are outperforming currently.
Okay. Okay. Point well noted. The other interesting thing was just to see how mutual funds have bought so much of money into private banks, and yet that's the bucket that hasn't quite done well. And because of the factor that Vinod mentioned, which is that FPIs have been large sellers and predominantly amongst the two large banks. Now, Vinod, therefore, the question that I have is, to your mind, what is the likely near-term trajectory, considering that flows may turn a little on the global side, on the passive side, if the Fed rate cuts were to come in, and by virtue of the fact that India's weightage in the EM basket is now a lot more than what it was, right? So therefore, do you sense that happening? I remember we were talking about the Fed rate cut led movements a year ago. It finally seems like it's around the corner.
So I think if there is a 25-50 bips cut, I don't think that's a surprise, because the bond yields are already below 4%. So the bond market is already signaled more than that. So if it is limited to 25-50 bips, it will be actually not a surprise at all. Um, uh, but the point is, if US avoids a recession and the interest rate the interest rate rise that we are seeing starts to moderate, and I don't see a massive cut in interest rates if the US economy continues to be robust. So the latest ISM data about services and jobs were for July were quite robust. So uh, and you have to remember that US is at the forefront of the AI renaissance, the investments in energy, and also you can't write off that country in terms of productivity gains. They are at the forefront of what's going to drive global productivity and the investments there within that. So a lot of value will be created, I think, in that economy. And the latest data doesn't suggest that even for the short term, we are seeing some kind of I think the US recession calls are, at this point at least, speculative in my view. Um, you may end up with a scenario where there is no recession, but a slowdown in growth while the interest rate environment moderates, which I think will be a reasonably good environment for equities. But the valuations, even in the US is the only country which is more expensive than India. I think valuations don't have any scope for further expansion. So I think there will be, uh, I mean, a phase of where the stock prices don't go much, but they will go on the positive side, but not high returns. But nevertheless, some kind of positive returns. That's how I see currently
Okay.
the Indian and US markets.
Okay, okay. Vinod, I wanted to talk about consumer durables, industrials, because where FPIs and MFs all have invested, but we have a management of Mazgon Doc ready to talk to. So I just want to, if I can, before we wrap up, can I just ask you for a very quick view on some of these shipbuilding / defense names, because they've seen tremendous book-to-bill ratios, some concerns in the last couple of days when the stocks have come off. How do you as a strategist look at some of these names wherein they might be priced to perfection near term, but the order books are very, very healthy? How do you see them?
So I go by this simple principle. You may be buying a great business with great potential, but if everything or more than what warrants is getting in the price, I don't think they are great investments. So you have to look if something is at, let's say, growing at, let's say it can grow significantly at, at a rate of around 15-20% over a long period of time. But if the valuations are like 100p and all, so I think that's the key. So the order book and the growth may still be there, but if the valuations are something which is out of the realm of reality, I think then you have to go slow on those stocks without naming the stocks.
Yeah, agree. I don't want you to name stocks, of course. Just wanted your view on how do you think about it. Okay, great. We'll try and talk about the business with Mazgon Doc, but Vinod Karki, take a moment to thank you. By the way, really good note, Vinod. And maybe the next time that we talk, I'll borrow some of the things that you've written in this note because I think it'll be relevant. So maybe have you a lot earlier than what we usually keep the gap between two interviews, if you have the time, that is. But thank you so much for the time today.
Thanks, Niraj.